We were going to talk about taxes. And, the interesting thing when you don't know much about taxes is you're convinced that there is this list of secret deductions out there that if you just knew about, or if you just found the right person to prepare your taxes, that you would pay dramatically less in taxes. And of course, tax preparation firms, tax advising firms like to keep this idea alive. They're just soliciting business, though. There are no secret tax deductions out there. Yes, you do have to learn a little bit about the tax code, but for the most part, the way you lower your tax bill is by changing your financial life. You got to be careful though. The goal is probably, if you think about it, not really to just lower your tax bill. The goal is usually to maximize your after-tax income. And those are very different things because the easiest way to lower your tax bill is to stop making money. You don't make any money, you don't pay any taxes. In fact, you're probably getting money back the way our tax system works. And so make sure you're not doing things just to lower your taxes. You don't want to, poke yourself in the eye just to stick it to the man. But when it comes to doctors, here are some of the tax deductions you ought to be thinking about and ought to know about and, probably be using. The number one, probably the biggest tax deduction for most doctors is their tax-deferred retirement plans. Whether these are 401ks, 403bs, 457bs, cash balance plans, whatever. HSAs, I'd even throw in there. But these retirement plans basically take money off the top. So if you put $50,000 into a tax-deferred retirement plan and you were making $300, now you're only paying taxes on $250. So that might have been in whatever bracket that's in, 33%, 35%, whatever it is. But you just saved that. So if you put $50,000 in and you're in the, 33% tax bracket, that's your marginal tax rate. 1/3 of that, what's that, $17,000 or something, just came off your tax bill. So yes, you'll have to pay taxes on that money later. But if you're like most docs, you'll be taking that out, maybe even in the 0% tax bracket, probably some of it in the 10 and 12% tax bracket. There's a big difference there. Plus, it grows for all those years in a tax-protected way, further reducing your tax bill. So your tax-deferred retirement plans, if you were in your peak earnings years, max those things out. That's your biggest tax deduction. Not only does it, reduce your taxes, but you still have the money. It's like the best tax deduction ever. All right, here's another one. The Backdoor Roth IRA. Okay, and this doesn't reduce your tax bill this year, but it reduces the taxes on your investments, both for you and for your heirs. By putting money into a Roth IRA in your 20s or 30s, you might have 60, 70, 80, 90 years, counting your heirs, of that money growing in a tax-protected way, and that reduces your taxes. So most savvy white coat investors, assuming their employer isn't offering them a SEP or a simple IRA, are also doing a backdoor Roth IRA, and they can do it for their spouse as well. If you've never heard of this, check out our tutorial. Just Google backdoor Roth IRA tutorial. Maybe throw white coat investor into your search. It'll pop right up. It'll take you through every step and how to avoid all the mistakes that people make every year with it. It's not that complicated, but somehow people manage to screw it up every year. You can do your backdoor Roth each year. Another big tax deduction is healthcare. Healthcare is really expensive, no doubt about it. But the truth is, you can pretty much pay for it with pre-tax dollars. Okay? When your employer is paying for your healthcare, and for most of you that are employees, they're paying a significant chunk of it, probably 80% or so of your insurance premiums. That's all pre-tax. If you're your own employer, that's pre-tax to you. Likewise, if you have a health savings account, you can spend pre-tax dollars on your health care. And so that can be a big deduction. Even if you're self-employed, you can put a line on there on your taxes. I think it's Schedule 1 that allows you to pay for that using pre-tax dollars. So a big tax deduction there. Another big tax deduction is business expenses. And for this, you generally have to be self-employed, at least for some of your income. And, any business expense is paid for before you pay tax. And so if you are self-employed, anything you need to run your business, it might be computer, might be cell phone, might be scrubs, might be CME expenses, licensing and DEA costs, credentialing costs, whatever. That's all pre-tax dollars. And so that's a pretty significant deduction as well for many doctors. If you have a special, what do they call it? Specified service business or whatever it is, like medicine or law or something like that. You may also benefit from what's our biggest deduction here at the White Coat Investor, which is the 199A deduction. Now, this one only goes through 2025. But if you own a business, you should know about the 199A deduction. Okay, this is the ordinary business income deduction. It's basically a deduction that was put in place back in 2018 in order to allow S corps and partnerships and sole proprietorships to, be on even ground against C corporations when the corporate tax rate was cut to 21%. So you ought to know what that is if you're self-employed. Now, a lot of doctors aren't allowed to take that because they have a specified service business and they make too much money. But you ought to look into it and see if you're allowed to be taking that deduction. It's a big deal if you are. Okay, here's another one. Buying a home. I mentioned if you change the way you live your financial life, you may find that you have a lot more deductions. And one of those things is buying a home. The reason why is mortgage interest is deductible. And given that, interest rates are significantly higher now than they were a year or two ago, you might be paying a lot of mortgage interest. Now, it's not necessarily a good idea to pay $1 to get a 33%, a 33-cent deduction. But if you're going to buy the house anyway, you might as well deduct that mortgage interest. And so that can be a significant deduction. Another one is giving money to charity. Again, this is changing the way you live your financial life. But every dollar you give to charity, assuming you itemize, and if you don't itemize for small amounts, every dollar you give to charity, you're not paying taxes on. And so that can be a pretty awesome deduction. It's even better if you're donating appreciated shares, because then neither you nor the charity pay the capital gains on that, yet you still get the entire value of what you donated for, a charitable deduction, assuming you've owned the shares of whatever it was for at least a year. Okay, and another one that many doctors use or don't know to use is tax loss harvesting. And if you have a taxable investing account and you've lost money, you ought to sell what you lost money on and buy something that's pretty similar to it. And that way you haven't changed your overall investment strategy, but you have harvested that tax loss. And those are very useful. You can use $3,000 a year of it against your ordinary income, and you can use an unlimited amount of it against any capital gains. And so that can be a useful tax deduction as well. But there's not this list of super secret tax deductions out there. And when you start looking for those and talking to people that think they're finding them, a lot of the times you're committing fraud. You're evading taxes, not just avoiding taxes. And so you got to be careful with that. I can't tell you how many doctors I've run into who think they have a legitimate tax deduction and they really don't. For example, they're deducting some lease that they're just using to commute with, and it's totally non-legit. If they ever got audited on it, they'd be hosed. But so keep that in mind.